instructor at the Options Strategist program over here at T3 Live. Having a lot of fun teaching a lot of people about options, different ideas, different thoughts, strategies, things like that. So tonight, what we're here for is a couple of things. One, going to try to give you a little sense of who we are and what our Options Strategist program is. Two, I want to introduce a lab that we've got coming up to teach people options trading and a good coverage of option strategies and ideas. And three, I want to give you a little bit of an idea of who I am and how I teach and the type of trading I do. So before we dive into that, let's do the traditional thing. And wow, that is a really And another reason I'm here is I'm going to complain about my picture. Wow, I've lost weight since then. I look a lot better. So hopefully I can get a better picture up there. Before we get rolling here, just a quick sound check. Everybody hear me fine? The chat or the questions? Yes, yes, excellent. Great. Then we have to do the section I like to call Appease the Lawyers. T3 Live, LLC, the company is not an investment advisory service, nor a registered investment advisor or broker-dealer, and does not purport to tell or suggest which securities or agencies customers should buy or sell for themselves. The independent contractors and employees or affiliates of the company are not, may hold positions in the stocks, options, currencies, or industries discussed here. You understand and acknowledge that there's a very high degree of risk involved in trading securities, options, and/or currencies. The company, the authors, the publisher, and all affiliates of the company assume no responsibility or liability for your trading and investment results. It should not be assumed that the methods, techniques, or indicators presented in these products will be profitable or that they will not result in losses. Past results of any individual trader or trading system published by company are not indicative of future returns by that trader or system and are not indicative of future returns which may be realized by you. In addition, the indicators, strategies, columns, articles, and all the features of the company's products, collectively the information, are provided for informational and educational purposes only and should not be construed as investment advice. Yay! All right. So, what are we doing here? Oh, I love this one. Clear your calendar for the next hour. We're going to make some options magic. Have to tell you that right up front that hedging costs extra. Wow. All right, who am I? Why are you here? What are we doing? I've been in the trading business for quite a chunk of my life now. Actually got into trading back in the late 90s. I had originally come from the computer science world, business world. I had run a software development company that I started up, built that up, sold it off. Late 90s were a great time for that, made a bunch of money. Ended up helping out a bunch of startups. Strangely enough, that ended up with me working with a venture capital group down in Boston, and out of the blue, starting up a high-frequency trading operation. Statistical arbitrage and high-frequency arbitrage mostly. Built that up, built out a shop of programmers, traders, got going pretty well actually. By 2007, I was involved, my company, which I ran, was involved in about $2 billion in stocks and ETF trading per week. We were doing at times up to, I think we peaked out at about 15% of the daily volume of the SPYs on a daily basis. So if you have a huge resentment against high frequency traders and trading operations, I can be one of the guys you can be mad at. That was exactly what I used to do. I will tell you this, it's not the most glamorous job, it is not the most exciting job, you can make some good money, but man is it stressful. So after years and years and years of working in high frequency trading, commuting between Maine where I lived and Boston, Maine and New York City for work, I managed to drop out of everything, move to the Bahamas, and sat on the edge of a beach for about a year and a half, almost 2 years. Very, very good decision. Did I say something guaranteed to make dollars? I can't guarantee anything. I'll tell you right now that honestly, trading is challenging. It can be very profitable. It can be risky. There's a lot of things to consider. And I'm not going to tell you you're going to make money. I will show you the best ways I know to better your odds and give you the best chance of making money. But that's about the best I can do. So anyhow, dropped out of life, lived in the Bahamas for a while, and then managed to get sucked back into the trading. Worked up in Chicago as the director of European tradings at a private trading firm, not exactly proprietary, private trading firm, and managed our electronic trading operations for Europe. Worked with a lot of derivatives, a lot of options, a lot of futures, a lot of different Forex products, things along those lines. Ended up having a really good opportunity to dive into that. Also got to know a lot of the people who worked on the trading floor. I was literally directly across the street from the CBOE. I can't say I worked the floor itself, but I drank with lots of people that worked on the floor. So I'm not really sure what that gets me. Anyhow, I figured out that Chicago is cold. And after living in the Bahamas for a few years, cold wasn't going to do it for me anymore. I didn't really want to raise my soon-to-be here daughter and wife in very, very cold Chicago. Ended up moving to Florida and opened up basically some a money management group. And that's what I do today, manage money, and I also teach. Teaching's a lot of fun. I love doing it. It's something I very much enjoy. Trading can be a very quiet and lonely business. If you don't interact with people, you go nuts. So this is a lot of fun for me. I like working with people. It's fun to teach people the kind of tricks that I know to get you a little bit of an edge in the market, get a little angle on things, and improve your trading. So on that note, Brett, how has the HFT edge changed in the last couple of years? Is there still room to gain speed for statistical arbitrage in U.S. equities? My personal opinion is it is dead. High frequency trading, this is completely off topic, by the way, but I'll answer the question real quick. High frequency trading has gotten to the point where systems were so good that we were literally scraping nanoseconds off our times to try to beat the next guy. And there's not a massive amount of profit margin in each one of those trades. You slip much, your profitability for the day, poof, goes away. The people who are getting the most advantage out of high frequency systems are the companies like Goldman Sachs that can leverage those fractional improvements in the trades over massive amounts of trading. And it's not so much about making them profit as leveraging and getting a slight edge in the profit on their other trades. Last time I checked, I wouldn't go back into high frequency trading. It's you end up spending millions of dollars on hardware and software to try to stay ahead for the next 3 months. Very challenging game. But on the other hand, options aren't. Options actually have a lot of possibilities for people, and you don't have to spend millions of dollars to do it. So let me see here. All right. What I'm going to do is let's actually take a look at a couple of things that I have been working on and doing lately. Now, let me set the stage for what we're going to talk about. As I told you before, I want to introduce the programs I've got. I also want to introduce me, which I've done a bit. But more importantly is give you a sense of the style of trading that I do. Now, I've got you here for about the next hour. I don't want you leaving without feeling like you've gotten something useful and valuable about this. So if I never see you again, at least you'll have a decent impression of me that I gave you something that you can actually use. So over the next hour, I'm going to cover 3 actual practical tools that you can use in the market right now. These are trades that are very typical of the things that I'm doing in my Options Strategist program, typical of the things that I teach, how I show people how to look at the market, look at the opportunities, and decide whether or not they've got the right situation to create a profitable, basically profitable trade or a potentially profitable trade. So what do we have out in the market right now? This is a big part of what's driving trading. We've got a really strange situation. In fact, the markets right now are, I don't even know how to describe it, bizarre. We've got a lot of things that we've never seen out in the financial world. Worldwide, we are getting to the point where we have almost negative interest rates popping up all over the world. That's affecting things. We have this run in the market. By the way, right now, the U.S. stock market, the U.S. equities market, is in the third longest bull run we have ever had in the market. The two better bull runs, the two longer bull runs, ended in 2001 and 1929. And for those of you who've been around the trading for a while, don't expect too many of you were here in 1929. I certainly wasn't. Neither of those dates ended terribly well. We're in the third longest right now, creeping up on the second longest. We have 5 quarters of earnings announcements, the past 5 quarters of earnings announcements, where the market has, or where the companies in the market have had earnings going down and down and down. We have been in an earnings recession for 5 quarters. We might actually pull out this earnings quarter with a slight gain, which would be a nice thing. The flip side, though, is the market during that entire period of time had a couple of nasty little dips in it, but the market's been going up. Now, that's creating a second problem. We have a massive difference between where the prices in the market are, the valuations, and where a normal pricing valuation is. As a matter of fact, right now, we could have over a 15% drop in the price of the market, and it wouldn't even get us to the average price to earnings ratio that we've had over the last 10 to 20 years. That's how high we are. In fact, we're at the 90th percentile right now. We have only had valuations of companies higher than this 2% of the history of the stock market. That's a risk. Now, risks are touchy little things. Doesn't mean that tomorrow we're going to have a crash. I'm not calling that. I'm not saying that we've got apocalypse tomorrow. Despite the fact that I continuously seem to get these emails in my inbox saying US dollar doomed on September 30th, the date keeps changing for some reason. I'm not sure why. It never seems to happen. Well, there's a reason for that. The market can stay doing what it's doing as long as it feels like. The problem is that after a while, fundamentals do come home to roost, and we kind of have to justify the valuations of the companies we're trading. Well, we don't, but the market does. When valuations are so high, there's a big portion of the market out there that doesn't want to buy. They want to buy low and sell high. Buying right now is buying high, with the potential that later you sell low, which is not a good plan. We've got a lot of risk. There's a lot of potential that things are going to fall. So there's the number one thing framing my thinking right now. Problem is, I can't trade it. I'm not gonna put a trade on right now that says next Thursday the market's going to crash. I don't know when that's going to happen. I don't know anybody who actually does. I have to trade what's in front of me right now. And that's what I have to do, or I don't make money. I either walk away because of my fears, or I figure out how to make money with the trades that are sitting in front of me right now, with the risk that at some point we might have some kind of crazy correction. So when I'm building out my trades, when I'm building out my portfolio, when I'm teaching people the ideas behind the trading that we're doing, we keep that in mind. We want to understand the situation we're in and build out a portfolio of trades that is strong and resilient in case something bad does happen, but is also focused on trades that can make money based on what's happening right now. We want to get a good blend of trades, a very diverse set of trades, build a portfolio that's balanced out so that we don't have too much risk of the market shooting up, the market shooting down. We want to be careful about volatility, making sure that the trades we take aren't overexposed in case the market does a correction and volatility shoots right up. And we also want to do trades that are not sensitive to quick one-day movements in the market. Today was a good example of that. Let's see here. Yeah, Stan, I'm not into fluff too much. I mean, it's just, and by the way, I also really don't like what I jokingly referred to in the trading industry as apocalypse porn. The sky's falling, the world's going to end tomorrow, listen to my advice and pay me a bunch of money. Those people I don't know, they drive me nuts. Uh, so let me try to show you some decent things that I am doing and show you why I think they work, and hopefully give you enough idea that you can follow at least the concept on your own and use it later on. Ideally, if you like it, I'd love to see you come into my Options Strategist service, join the newsletter, or take me up on doing the lab and learn more. But I'll definitely give you something right now that is actually hands-on useful. All right, so we have a situation where the markets can get fairly flaky. In fact, today, a beautiful example of it. Here's the SPY. Boom. Midday, we had some big movement. Drops, I mean, really fast. We were, what was it, 1.5% down? Rallied back up, and I think we closed at something like 0.7% down. But these are the types of things that we're hitting all the time. Scary, quick movements. And then we seem to fall right back into the sluggish, sideways, choppy, not particularly going anywhere for any particular reason market. That's what we're living in right now. So one thing that I've taken off the table is something that a lot of people seem to get very, very excited about, which is super short-term trades. But it's interesting because when you start to look at things from a little different point of view, you can actually go the entirely opposite direction and change your world a little bit as far as the trading is concerned. So let's try that one out first. This is, by the way, this is a trade that or pretty close to the exact same trade that I have run the Option Strategist class portfolio right now. It's at least based on the same concept. We're running it the same way, and it's making us some very good money. So, a very popular trade and a very useful trade is an iron condor. Now, iron condors rely on stocks staying within a channel, going sideways, and they use time erosion or theta erosion, which is one of the tools we use a lot of in the options market, to make profits. A lot of people really love to do short-term iron condors. Now, I'll be honest with you, I'm not a fan of the strategy, and I'll show you why right now. So I'm going to trim this down to 1 year. If I took the SPYs today and did an iron condor, now by the way, today is not a bad day to place an iron condor because volatility jumped up a bit. That actually makes our trade have a little bit more premium, puts us in a better spot. I would probably go in and if I was doing a short-term trade, let's say, God, SPYs have so many expirations right now. Let's just say, let's see, October 5th. This is a very short-term one. 1 week. Actually, hold on. Today's Thursday. October 7th. There we go. 1 week out. I would look for a delta that I'm happy with, which is about a 15 delta. Defines my risk on the trade. Come on. Okay. Hey Jim, how's it going? No, I have not covered short-term trade in Costco. I probably won't touch that one, Jim, actually. But I am actually having a really weird problem right now. Give me 1 second here. All right, this is always fun. Everybody ever been in a presentation and basically have what you're using for the presentation blow up on you and die? Because that's what just happened. TOS has been a little weird lately. I like the platform a lot, but it is definitely acting funny right now. So if you bear with me, I'll try to log us back in and see what we've got. Constantine, this is I just rebuilt this computer system. Actually, this thing's a monster right now. I over the years I've built my own computers for trading for a long time, so I just had to rebuild this computer from the ground up. Uh, if it's giving me problems, I'm gonna be mad. All right, here we go. Let me see if we can make this work now. So, first pass. I want to try to do a basic iron condor on SPY, but I'm going to look at it from the short-term point of view first. By the way, I'm not actually encouraging you to do this. I want to show you, I'm using this to show you why I wouldn't take it this way. One of the things I usually do is I use delta to pick out the spot where I'm going to be working from. Generally on iron condors, I'm working from about a 15 delta. So that means I'm going to take a 209.50 put short. I'm just going to arbitrarily go down $2 in this. We're not going to worry about the spreads or anything, not doing anything too fancy, but I do want to just show off the general idea of the trade. So that means that the first part of this is a 207.50 by 209.50 bull put spread. And I'm going to put the second half on, looking for that 15 delta again. 218.50 by 220.50. All right, I have a $2 spread iron condor, I'm getting 42 cents on it. By the way, that's pretty darn good. There's nothing wrong with that. In fact, let's see, $2 spread minus 42 cents. I'd have a $1.58 margin. I could be making 26% return over, what is it, 8 days? That sounds pretty awesome, actually. So, why don't I particularly like this trade? Well, let me show you. 209.50 and 218.50. I might actually get a bit surprised by this by the way. These are my two strikes. If I were to just take a quick look at this as an iron condor, let me clean out all my other SPY trades. There we go. I have to stay between these two lines right here for the trade to really work. If I don't and it goes out, I actually get exposed to a fairly rapid loss. I could lose money pretty quickly on both sides. Now, this is why this trade bothers me a little bit. I have to stay between 209.50 and 218.50. Now, overall, I'm actually thinking that this doesn't look horrible. I've only got to be in there for 8 more days. But at the same time, the market has been doing some really, really quick movements on me. I can make 25% return, which is pretty good. In fact, I'm almost thinking that right now this is not the best example of what I wanted to show, but anyhow, we'll keep going with it. Here's the problem. It would take very little. You look at the way that SPY has moved during these days right here. These bars both happened on single days. And if I took this trade, even though I'm being paid very well to take it over the next 8 days, and out of the blue, the market decides to do another handful of these movements right here, I'm going to blow through either one of these sides. And that 25% profit looks like nothing when I'm taking my horrible, horrible loss. So to simplify, what I was going to get to is short-term iron condors in this kind of a market end up giving me ulcers. Iron condors are a great way to make money, but they're too dangerous right now. If the market moves really fast, and that could happen on any day, remember, we've got 8 days of exposure over which any one of those days we could see this bar, any of these big bars either go up or down right through our strikes, causing us to lose money. The reality of it is that's not a very controllable trade. You don't have a lot of management over that. You don't have a lot of ways to control the risk. If it goes against you, it's going to go against you very, very, very fast. So let's flip this around a little bit. let's look at a better way of doing this, or at least from my point of view. Most people like to pitch the idea of doing super short trades. I actually would encourage you to go the exact opposite. Let's go out to January. This is 113 days in the future. And let's set up an iron condor. We're going to use the same risk, which is the 15 delta. And by the way, I actually have trades on this right now. So we're doing a 192 by 189. So 192 by 189 bull put spread married to 227 by 230 bear call. Now, these are the same deltas, the same risk levels getting in, 227 by 230. Now, I've got a $3 spread, so a little bit different, but I'm getting 77 cents back in credit. So that means I've got a $2.23 margin on 77 cents. I'm making about 34% return on this trade. Now, it's taking me a lot longer to get 34%, so it doesn't look as exciting. But it's still actually, by the way, a very good return on investment. So divided by 113 days to the end, I'm making 0.3% per year. If you can continuously do that all year, or excuse me, 0.3% per day, sorry about that, you're looking at 111% return over the year. Now, I don't shoot for that, but it's nice to know where I stand. I end up with a different trade, a very different trade. Once again, it's an iron condor. It benefits from time erosion. By the way, this thing also benefits from the fact we had a nice little bump in implied volatility today. But it gives us a different perspective on the trade. Instead of those tight strikes, we're now using 192 versus 227. I have to stay between these two numbers to make this trade work. Let's take a look at what that looks like on the charts. What was that? 192, 227. That would be down here. Oh, come on. Roughly. I don't have to get too fancy on that. And up there. Now, I'm in the trade for much longer, but I now have effectively a superhighway to drive this thing down. It is longer term, but if the market should do a couple of quick movements, even if it were to go and do a fairly large scale movement, I've got many, many days worth of movement, price movement in the market before it would ever even get close to my trade. Now, that gives me a lot of ability to manage the trade, but it also gives me the ability to do something else. And this is the real goal of what I'm doing. And this is for people who do trade iron condors. I'm just trying to give you some ideas of how you might be able to play these a little bit different during this period of time than we would during, say, a nice, confident, solid, normally priced market. By using the very, very wide strikes and a very, very long-term iron condor, what's going to happen is we're going to have two sides of the trade that are going to, we could effectively manage separately. There's a lot of room between the current price and 227. I don't think that the market's going to be shooting up to 227 anytime soon, at least not on the SPYs. I do worry a bit that we might head down towards 192. I think we have a risk of a correction, but the market is already building in a lot of that risk, and it's giving us strikes that are further out anyhow. We've got a lot of price movement before we get there, so we should be able to manage the trade moderately safely, even if the market starts to go against us, if we do go into one of those corrections. As the market moves around, I would be surprised if we didn't get some moderate moves. 2-3% drop, a little bit of a rally up, another drop down. It's normal in this condition right now. Very, very common. Those are the things that are going to be gold for us. So, generally, running this trade is a little bit different from what you might normally expect. I'm actually treating the two sides almost separately. I'm getting a certain amount of credit on the call side and a certain amount of credit on the put side. If the market starts dipping, moving down, I'm going to have a call that's going to reduce in its credit down towards zero, almost to the point where I can just throw the portion of the trade away. When it gets close to down to a low value, say 5 cents, 7 cents, I close it out. As long as we're moving in this choppy sideways market, what happens then is I've locked in my credit and I wait for the market to jump back up a bit and I put a brand new bear call spread on, adding more credit to the trade, reducing my overall risk, and really, really ramping up the profitability of the trade. Same thing happens on the put side. If the market drops in implied volatility, by the way, both of our sides of our trade will be making a bit of money. If the market rallies up a little bit, not necessarily going all the way to 227, but let's say we start touching on new highs around 219, we're going to see the put side of the trade, the credit that we received eroding down towards zero, which gives us a great opportunity to close it out. And we can close that out, lock in the profit on that side, wait for the market to then do another dip, which it very likely will. We've got a lot of quick dips and movements lately. Gives us lots of opportunities to do this. And when it does, we place the trade again. And what's interesting is that we're never changing the overall risk on the trade. The risk we're getting into is based on the deltas that we put on in the first place. When we have the one side of the trade drop close to zero, it no longer has any benefit to us. It doesn't protect us in any way. It's basically not worth anything more, or at least not worth anything in the future. We close it out. The margin on the trade doesn't change in any way. When and if we have that opportunity, if the market then pulls back as it goes choppy back and forth, we then have the opportunity to replace that trade. When we replace it, it doesn't cost us anything. As we do this, each side, now we are building credit into the trade, and each time we do, we're actually reducing our overall margin, spreading out our break-even points, because every credit we add to the trade adds more money in our pocket and more protection against a loss, and gives us the ability to have a more and more profitable trade. Now, is there a risk? Absolutely. Every single trade we ever take is going to have a risk. But is this a good and manageable risk that we can use to make some money over the next 3-4 months? Yes. This is a very reasonable trade to manage. It's actually one that you can sleep on. It makes good money. Even if we never do one of those adjustments, we're still looking at making, let me see, that's 34%. And I consider that a pretty reasonable return on investment for 4 months. Let's see, some of the questions. How long would I go to collect, let's see, how high would vol need to be to get $1 to 120? Oh God, you're hitting me with some tough questions here. You're making me do math after I've had a long day. Let me see if I can give some insights as to what's going to go on here as we have volatility changing around. First of all, I'm not really playing like set strikes versus high volatility. My trade actually adjusts itself based on what the market risk seems to be. So as volatility goes up, the strikes you take go further and further out. We're using a fixed delta, which is about 15 delta. Now, what that means to us means that we've got about a 15% chance, based on the market pricing of the options, that the stock is going to go through either that strike on the way up or the strike on the way down. It allows us to line up the strikes roughly in an area where, bluntly, I don't want to put a whole lot of effort into the trade. I don't want to have to manage it every minute. I don't want to have the thing blowing up in my face. So by going out to a reasonably low delta, it's not the lowest in the world, I have a high probability trade that ends up being quite manageable overall. And then using the movement to allow me to move in and out of the put side or the call side allows me to add credit into that and improve and beef up the profits over time. Ideally doing it, I'm not exposed to, I could have a 3-4% change in the market and I still wouldn't touch my strikes. So that's the goal of this one. How frequently do we need to manage? David, this particular trade is actually a low-touch trade. Now, I have got other trades that I do in the Options Strategist program that are high touch. And we do some trades that are, actually Jim was mentioning it earlier, the earnings trades. And I didn't do Costco earnings tonight. I just couldn't find enough profit in the whole thing. Those, we get in one day, we're out the next. That's about the fastest trade I would ever do. Most of the trades that we have in the Options Strategist program, you probably have to deal with them, like actually do a transaction on them once every week and a half, 2 weeks. Most of the trades last anywhere from about 3 weeks to 5 weeks, and some of the trades like this one can last 3 or 4 months. This trade right here, you would probably go 2 to 3 weeks at a time without ever needing to do anything to it. Each day gives you a little bit of profit from theta erosion, and then when you have the opportunities by the market moving, you take them. And you can set that up on alerts to let you know when the stock hits certain levels or the trade hits certain levels. And that ends up being a really good way to just wake you up and say, hey, take some money. Or you can pay attention and look at it each day. The one thing you shouldn't have to worry about is being out of your golf game and then coming home and finding out that the market did something crazy and you just took a blowout loss. That's what I'm trying to avoid with this. I don't like having to manage stressful situations. It just stinks. So there we go. Jim, I probably wouldn't use the Thinkorswim analysis to do probability of a profit on this one. You're going to get me into one of my rants, which I really don't want to do because it'll take all night, but Thinkorswim's math on that is piss poor. I could show you how and why, but it's basically a circular argument. It never actually tells you anything. There's other ways to look at things, but and there are ways to figure out odds. I would personally recommend paying a lot more attention to historical volatility than implied volatility to figure out your probability of success on these. And I don't have time to dig into it tonight, but there's a lot you can learn from those two numbers right there. All right, so there's trade number one. Conceptually, you're looking at a longer-term iron condor instead of shorter-term. You're looking for the opportunity to close out either the put side or the call side when you have the when the movement allows you to get those down to closer to zero. You're waiting for the movement to come back. You find a place to put the trade in again. You use the same deltas. You add in a new put or call to replace the one you closed, generate more credit, improve the trade. So that's the general idea. Now, if I had 4 hours, I could go into every little detail on it, but I regrettably don't. So I want to show you two other things tonight that should help you and at least get you heading in the right direction. Brett, what other ETFs can you do this on? By the way, you could, stocks are harder because you run into earnings announcements. I actually use this on a lot of ETFs. I just put one on DXJ, Japanese Hedged Equity Fund. I actually have my handy dandy little ETF list. And I will run through this trying to find different ones that fit. Now, I haven't played with that one, but that actually looks interesting right there. By the way, I didn't plan that. There's a lot of ETFs that this can work on. It's definitely not just a SPY trade. Follow the concept and work through the ideas, and you'll see how it works. All right, I am going to move on. Sorry if I'm missing anyone's questions, but we got a limited amount of time. So, let's see. Jim, which historical volatility algorithm do I prefer? I can't stand the log normal standard deviation one that every brokerage seems to use. There's a couple out there that are much, much better historical volatility algorithms. The ones that, if you're interested, I would look up at the Yang, Lang, and the other one that I personally use a lot of is the Rogers and Satchel. But you're going to have to dive into some of the academic literature to find much on those. All right, let's go in a different direction. A stock, Herbalife. Now, somebody earlier I saw this comment, didn't have a chance to respond to it, but was saying implied volatilities are so low right now that it's hard to sell for a credit. And you're right, it is. Now, there's something you've got to keep in mind. You're not playing the implied volatilities high or low. You're playing the implied volatility of the options versus what the stock is likely to do for price movement. Now, that's the real trade. Now, when you've got a high implied volatility, you've often got an advantage there because that gives you more room between what you're getting paid to take the risk and the real risk you're taking. But it doesn't necessarily mean there's no opportunity out there right now. They are a bit harder to dig up, though, and I will definitely give you that. And the other thing is, a lot of us have a tendency to build out portfolios that are heavy into basically credit spreads. They're great trades. Vertical spreads, iron condors, wonderful trades, good ways to make money. I like them a lot. Problem is, you build your portfolio out of all of those, suddenly you have this ghost problem, this problem in your portfolio you don't really realize you have. And it's called your excessively short volatility. Now, what's the issue there? All of the trades that I just talked about, iron condors, bull puts, bear calls, pretty much credit spread trades are heavily short volatility, which means that they do very well if volatility goes down. It accelerates the rate at which they make profits. But if volatility suddenly goes up, it either hurts their profits or makes them go into a loss. And that can be dangerous. So we need to find some ways to get some income, create some decent trades, and to protect ourselves against the market doing crazy things. Not the easiest thing, but let me show you a quick little trick you can do with calendar trades that most people don't know is there. I'm sure there's some people here who do, but quick question. Calendar trades, how many of you have used them? And actually the real question is, what makes you your money in a calendar trade? This is shorting an option strike with an expiration in the moderately near future and going long on an expiration further out in the future. Same strike. Anybody have any thoughts on that one? What makes you your money in calendars? Jim, you're cheating. You've heard me talk before. It's not fair. Okay. I love it when people tell me it's time erosion because that's actually not the one. It helps me make my point. But I think I got too many people here who've listened to me before. Volatility are beautiful, beautiful, beautiful trades on volatility if you use calendars. So let me show you how this works. Here we have Herbalife, which historically has had quite a bit of volatility in it. Now, I would have liked to have grabbed this when its volatility was a little bit lower, but I need to be able to show you something, so I'm going to work with what we've got. Notice that the volatility we're at now is pretty much well below where the volatility has been in the past. And this is what we're looking for. Now, as I said, I would love to have set up this trade a little while ago when volatility was even lower, but it'll still work out. There are times when implied volatility drifts right down to the bottom on different stocks, and stocks have a natural level of volatility. The options on stocks have a natural level of volatility. There's a certain riskiness to certain stocks. And when you get way down near the bottom of that, you're not going to go down much more in volatility, but you certainly can go up. So let's set up a little trade on Herbalife. I'm going to use something called a dual calendar. And let's see here. I'm going to set up a very, very simple dual calendar on Herbalife. Actually, did I already do it? Yes, I did. Okay. So let me walk you through what I did on this. I'm going 2 weeks out into the future, 14th of October. This is not a long trade. Something strange is going on in this one. Hold on. Something has shifted a bit since I've set this up. Oh, I know why. It didn't save. Okay, let me go back and set this up. 14th of October. I'm looking for somewhere around 30 to 33 delta. I am going to go with a 59.50 strike. Now, this is a little bit over 30. I'm going a bit wide to give myself some room. 59.50 put strike, and I'm going to go short on this. And this is expiring on October 14th. So I'm going to give myself some credit right now. I'm going to go and hit roughly the same delta on the opposite side. In this case, it is 63.50. So I just sold short a call, and I sold short a put. This creates what's called a naked strangle. It's probability-wise a well-paying, decent trade. Problem is that it gives you one of these horrible things. Hold on. Anytime you see your risk not tapering off and just heading down negative in either direction, that's generally a bad sign. That means you've got unlimited risk, and you could be, depending on something really crazy going on, you could actually lose a lot of money, like potentially more money than you have in your account. We don't ever want to do those. There's better ways of trading. The problem with this is that the brokerage knows how much risk is in this trade, and they're going to charge you a lot for it. So we set up a dual calendar, which is this. It's a little trick where you go take these same short strikes, 59.50 and 63.50, and go long. Now, we just turned this from a credit trade into a debit trade. But what we're actually trading is the credit that we received is going to erode down to zero, which is good for that. It's going to make us money as we get closer and closer to October 14th. Now, we're going to lose a little bit of money on the two long options, the 21st of October, same strikes, a 63.50 call and a 59.50 put. We're going to lose a little bit of money on those, but not as much as we make on the shorts. These are going to erode faster and go towards zero. So we're going to, at the end of the trade, which is on the 14th, 2 weeks from now, we're going to close the entire thing out, get money back from the longs, and ideally not spend anything on closing, or spend almost nothing closing the shorts. It gives us a trade with a P&L that looks like this. Hold on, there we go. A weird looking little trade, but a really kind of neat one. Now, a couple of points that I want to pay attention to on this. First of all, over the next 2 weeks, I need to have this trade stay within its own break-even range. So I am looking at 58.35 on the bottom and 64.67 on the top. It's going to go back to the chart and drop in a couple of lines and see where that is. Let's drop this down to a year so we can see this a bit better. 58, no, that's not the number I need. I need 58.35, 64.67. It's going to be a little tight. Okay. And I'm going to put one more thing up on here, which is the 14th. Okay. Let me zoom this in just a little bit. Can this price right here stay within this box over the next 14 days, 15 days? As long as we do that, we're in a decent shape in the trade. And by the way, this is a fairly good paying trade. We would be, at this point, I haven't scaled this up, and I would size this up to a bigger trade, but we're basically taking about $720 worth of risk for, let's say we don't hit the max, let's just say we hit somewhere in the middle, about a $300 to $350 profit. So there's a potential, as it stands right now, for about a 50% return in 2 weeks. Now, I would like to have that a little wider. I'm not super comfortable with it being fairly tight like that, but in general, it's not horrible. As long as we stay in this general range, we're doing pretty good. Now, it's an okay trade. It's a decent trade. But the key is I want to illustrate a very, very important point about the trade and why this is an amazing tool in your portfolio, an extremely good tool in your portfolio. worst case situation we can have, and literally it could happen any day. Not going to dwell on it, not going to get all psyched out about it, but we could see the market correct any day. I didn't expect today to be such a big movement. When and if the market corrects, Herbalife is going to get dragged down with it. It's pretty much given. Maybe it won't move quite as much as the rest of the market. Maybe it'll move a little bit in its own way, but it is going to be affected by a correction. So if the market corrects, what's going to happen to this trade? Well, let's play around with those numbers. First thing I want to do is see what Herbalife did last time the market corrected. So Herbalife, it pretty well went down with the market and did what everybody else did. Now here's the key though. What happened to the implied volatility? There we go, right in here. This was the implied volatility of Herbalife reacting to the market going into a correction, which is what we might see. Now, implied volatility on Herbalife went up and peaked out around 86. I'm not going to be so aggressive about it. Let's see what happens to that trade just a second ago. If implied volatility goes up to, I don't know, let's just say 60, I'll get an average of about 33% implied volatility. Let's add 30% implied volatility. That would not bring it up to the max implied volatility it saw during the last correction. It's actually only a portion of the way there. But let's see what this trade does. Now, a couple things to point out. This line and this line will stay the same, and that will be where our break-even points are right now. So 30% implied volatility, boom. We still have a max risk of about $720 on this trade. Our profit, on the other hand, remember, we haven't scaled this up. Our max profit could be up around the $2,000 range. So we're talking about close to a 300% profit. But the key is, look where our break-even points are ending up. Way the heck out. As implied volatility goes into the market, the long options are going to go up in value. And since the short options are expiring in a relatively short period, they don't get as affected. Now, they are affected, but it's not as significant. This is a type of a trade that is a very, very handy thing to have in your portfolio when things go bad. It is what I call a graceful failure. Now, if things are acting normal in the market, I'll manage the trade. If things are shifting around, even if the trade's going bad, that's fine. I've got a plan. I know what I'm going to do. When I hit a certain point, I'm going to be paying attention to determine whether I think the reason for the trade is still good. I'll make my decisions. I'll cut my losses. I'll walk away. I'm not worried about that. That's something that we do as traders every day, and we're used to it. And we can learn to be better at it, but it's not something that I consider a horribly, horribly hard thing. On the other hand, when the market blows up in our face, we're scrambling to deal with problems left and right. We've got trades failing all over the place. If I had this on as an iron condor and the market did a correction, it's going to blow right through my strikes, and the rising implied volatility is going to hurt my trade and cause me to lose more money. On the other hand, if I do it as a calendar trade, like I'm showing you right here, that happens to happen. Implied volatility jumps up and it actually adjusts itself for the risky situation, gives us the potential to make a lot more money, and even if it loses, it's losing at a far slower rate and much, much wider break-even points. We walk away in much better shape. I'm not going to say you're not going to take a loss, but I will take a tiny loss that's a lot more controllable over a catastrophic blow-up-in-your-face loss every day. Build some of this into your portfolio that's got a lot of vertical spreads, iron condors, and you've very quickly reduced the volatility of your overall portfolio. And if you do them on trades that look like they're good, profitable trades, at the same time, you're still exposing yourself to profit. It's one of the best ways to reduce the risk in your overall portfolio across the board. So, hopefully that was a bit interesting. Thomas, why not a single calendar with less gamma? You certainly could. Absolutely could do that. The problem is that you're narrowing the range over which the trade works, and I wanted to have a reasonably wide range. I wanted to make it safe and more manageable. A single calendar would actually be more profitable. It would have a much higher potential profit and would work in the same way, but you've got to be more right about it, and it's got to be and the stock has to stay within a narrower range. It's a trade-off. You give up something and you get something. Higher profitability versus you have to be more right. That's the trade-off you're really looking at in that situation. Okay. Hey, Tom, I've got to be careful. This has nothing to do with what you were talking about before. I need to stay on topic on that on this. Different places, different things. Sorry, talk talk to me outside this, Tom. Sorry, I get a lot of people that I've worked with in the past, and it's always good to see you. But all right, what else do we have here? What happens if it goes below or above? All right, good question. What you have, the strikes that we have, they're not the same as an iron condor strike, where you have to really be radically worried if the stock goes outside the range. Ideally, I would like the stock to stay inside the range. But the profitable area actually extends quite a bit beyond the strikes. As the implied volatility in the market goes up, the area over which it's profitable goes out further. My break-even points go further and further and further out. So remember, these were my break-even points before I adjusted volatility. And these are the break-even points at expiration after I adjusted volatility. And by the way, if it happens in the middle of the trade, the break-even points are actually even further out. So it's a bit different from an iron condor. You're looking at the range over which it's going to be profitable, or break-even or above. And that's what I'm generally looking at on this trade. The strikes themselves, you want to be careful. There's a natural tendency to think that you're going to make the trade safer by making the strikes wider. And that's not entirely true. At a certain point, matter of fact, let me adjust this down. At a certain point, what you end up doing is you actually create a point in the middle of the trade where you lose money, and you make both of your peaks significantly lower. The return on investment of the trade is not as good. The area over which you're going to win is not as good. I usually try to keep it between a 30 to 35 delta on both sides, and that generally puts you in about the right range. That'll get you in roughly the right place. Now, I apologize. I can't stay here and go through every single question. We've got very limited time tonight. In fact, I'm running up against it as we speak. So if everybody's willing to take what I just gave you as some hopefully helpful, interesting ideas that you can kind of pursue a little bit more yourself, I'll move on. I'm going to do one more piece, hopefully another useful little tool for you. Try to knock that out and then cover a couple of things about the lab, and hopefully everybody can go off to dinner with their families. I'll try to cover some questions, Thomas, but I'm actually very, very limited on time. I was pretty much given a hard and fast rule that I was supposed to keep this to an hour, and there's other sessions that are going to be using this in a little bit. So I'm trying to give you as much value as I can in a tight, short period of time, and it's really hard to answer all the questions. We will be having more sessions like this coming up. We're going to be doing some promotions for the lab, and I'll try to answer questions in that. Not trying to blow you off, but I am pretty limited. Honestly, the best thing to do is, if you're really interested in this, if you think that this is something that would help your trading, and let me be blunt about it. Some people like to do super high speed in and out day. Other people have a set of tactics that they use. Different people like my styles. Different people don't like my styles. If this is something that appeals to you, the lab would be a good fit. And I'd like to have some people in there that it's a good fit for, because I want to make sure that it's valuable to you and you can use it and actually help you improve your trading and make money. So think about that as we go. If this is the types of things that you want to learn to do on a regular basis, and it fits your trading style, I think that the lab would be a good thing for you. And the strategy service newsletter would be a good thing for you. On the other hand, it may not be anything like what you do. So just think about that, and if I can bring some value to what you're trading, that'd be great. All right, I'm going to move on to VXX real quick. Yeah, and Mendy, I like this. This is actually one of the things that does help you keep balanced a lot, and I like that. When we've got craziness out there, find ways to make things more normal, and that's a very, very valuable thing. In fact, it's something that I find that people trade to pursue profits so much more than they trade to pursue control. And profits are great, but they can disappear so fast, and just poof, suddenly you've lost a bunch of your profits, you're back at square one, or worse, below that, and you're fighting to get back up again. My general philosophy is I like to create a situation where I'm maybe not swinging for the fences, but creating a nice, consistent return on a regular basis. This has been a good year for me for that. I wouldn't say that it's home run range, but I've been steadily moving up, and we had a couple of hits, but we're at 21% return right now in the Options Strategist Classroom portfolio since the beginning of the year, and significantly better than the market, and the returns are significantly steadier than the market, which I like. So there's my goal. That's what I want to do, and I want to continue that out. I would love to hit 28 to 30% return if I can do it by the end of the year. That would be a nice, solid year for me. We'll see. But that's in the Classroom portfolio. So next little piece is this. Okay, fundamental problem. We have a market out there that's got me worried. Actually, a better view of this is this. What am I worried about? I'm worried about this. That was last August. Market dove. Just dropped through the floor. Very, very fast. No control. If you were trading options at that point in time, you probably took a loss on at least a significant portion of your positions. And then followed along this. And back here, this. This wasn't quite as bad, but we're in a situation right now where we're likely to see another one or two of these come along. And this hurts for two reasons. One, because I could lose a bunch of money in my portfolio. There's my number one reason why it would hurt. But number two, I keep thinking about it and wondering when it's going to happen. And it cripples me when I'm trying to pick out my trades. The best way you can trade is by looking at what the market is doing right now. Just focus on what the market is doing. And put out of your mind what the market might do way off in the future. Now, I don't want you to ignore risks. I don't want you to forget about, things that could, bad things that could happen. But if you focus so much on that, you spend this huge amount of time not taking any trades because you're just afraid that the market might crash down. So this is what we've been doing in the portfolio. This is what this is what I use as a VXX hedge. Now, everybody always asks me, why do I use VXX? Why don't I use VIX? Why don't I use this? Why don't I use that? Well, VXX is what's called an ETN. It uses the VIX futures contracts to create a simulated position of VIX, the volatility index, 30 days in the future. Now, I use VXX, and it's what's called an eroding asset. I'll show you why they call it that. Because it goes down over time. I'm using VXX because it actually works better for me than VIX options. There is no such, VIX options do not have an underlying of the VIX. There's a big misconception there. VIX options actually use futures contracts. And because of the way they work, they actually, in a lot of cases, don't do what you want them to do in your trade. VXX takes and makes that problem go away. Now, there's other problems with VXX, but it's a nice symbol that will very, very specifically respond when implied volatility shoots up. Now, most of the risk in my portfolio is actually related to implied volatility. I want to make a sudden volatile event go away. So I'm shooting for VXX. Now, we can get into, I could probably do an hour-long discussion on VXX all by itself. There's so many details that go into the way the futures move, the way that the options work, the way that it relates to the VIX options, all kinds of things. As a matter of fact, if anybody's interested, go to a website called VIX Central, VIX Central, and dig into a little bit of the information that they've got there. It's more of a utilitarian page. It's just got a little information, but it does have some links to some interesting articles, some fun stuff to understand. Now, I'm going to build out a trade right now that is very, very likely to lose money. In fact, I want it to lose money. That may sound like the most bizarre thing in the world. But this trade that I'm going to build is designed to lose money 90% of the time. But that 10% of the time, or even less, when the market blows up and rips apart my portfolio and causes a fairly massive loss, it's going to be there to cover that loss and make my pain go away. This is what you would basically consider a straightforward, straight-up insurance policy. Now, anytime you buy insurance, you want to shop around, you want to try to find the least expensive insurance to cover you in the way you want it to cover you. So, first thing I have to do is I have to run through a little analysis of my portfolio. And I've done that, and I know that in general, if I've got my classroom portfolio of about $100,000, and we go through, take a normal portfolio for my classroom, and we go through one of those correction events, I'm going to lose between $7,000 to $8,000 in that portfolio as I manage the losses, as I'm trying to close things out. I'm scrambling. It's just face reality. I'm going to lose money. Now, I want to make my fear of that happening effectively go away. So, let's do a little bit of analyzing. I've done a bit of the math. I know roughly what we'll be looking at. If the market were to go into a brand new correction, we are likely to see VXX shoot up probably a bit higher than 60. That would be what I would expect to see for a movement from roughly where it is now and off into the future a bit to where it would be if the market goes into, say, 8, 10, 12% correction. This is going to shoot up. Now, I can't go through all the math on that, but please take my word on it that that's a fairly reasonable expectation. I want to protect my portfolio against that kind of event. So I'm going to go to the VXX options and get rid of all this stuff. Now, I've already done this out, but let me walk you through what I'm getting to. I want to take and go far enough off into the future that I've got an insurance policy that covers me for a period of time. Now, the further off into the future I get, the less I actually pay per day for insurance. The problem is there's a trade-off there. It's also that I get less response or less effective insurance earlier in the trade and more effective later in the trade. So there's a bit of a trade-off. I could go shorter period, spend more money and get a more responsive hedge. I can go longer and get a cheaper hedge. I'm going to, for illustrating this, I'm going to use December, but I'm also going to tell you a little trick that we've been using lately that's really a smart trick, and it wasn't mine, it was actually somebody in one of my classes. So I'm going to use a bull call spread. Normally you end up getting into bull put spreads. Those are high probability trades. Normal feature of a bull put spread is you make a reasonable amount of money, 15, 20% over a moderate period of time, 3-4 weeks. And you've got a risk if it goes really bad against you that you can take a much larger loss, but the probability of being successful is very, very high. We could be sitting on 80% likelihood, 85% likelihood of a bull put spread working, depending on how we set it up and what strikes we choose. That's the general idea behind bull put spreads. I'm going to flip this around entirely, and I'm going to create a bull call spread. First thing I want to do is I want to start out with the expiration I want. I want coverage for 78 days, and that uses December expiration. I want to find a strike that I'm confident that VXX would go through and move past. I'm talking significantly past if the market were to go into a correction. In this case, I'm taking a 52 strike. So, oops, I actually just did that wrong. There we go. I need to go long on a 52 strike. So we just bought ourselves a 52 strike call. If the stock goes up, goes through this, then we would have this call option making us money. Now, a lot of people ask me, why don't I just buy a call? Well, there's a lot of reasons. First of all, the cost on it is $1.80. The amount of money that I'd have to put into the hedge ends up being a lot more expensive. It doesn't necessarily, the problems with how it responds depending on when the stock market goes up and down, or how the implied volatilities move, actually gets worse. Biggest thing is I can actually make the trade better just by going out a few strikes. In this case, I'm not going to get super fancy. I'm just going to go with a 55, and I'm going to sell it short. Now, I took this $1.81 cost and now dropped it to 22 cents. All right, so now I have a very, very inexpensive trade. It's a 22-cent debit. And by the way, I can't lose more than 22 cents in this. I'm locked into that. So we have a very, very tight control over the cost of the trade. Let's figure out what we can get on the other side. 52 by 55, that's a $3 spread. So it's going to do a really quick little bit of math. 3 minus 22 cents. The max return we could get out of this is $2.78 if VXX blows right up through all of our strikes and goes up in that 60 range and this thing expires. So for 22 cents, we would make $2.78. So let's see. That is a leverage of 12 times. So for 22 cents, so if we put a $1 in and the market crashes and VXX does move up the way we expect it to, we get $12 back. Now this is the fundamental core of what I'm doing here. I've got a low-cost trade that bluntly is unlikely to make us any money unless the market does a correction. But if it does, it returns a very, very high amount of money and pays off a bunch of money versus a very low premium. Now, as a practical note, I am unlikely to make that 12 times my money just because we would have to have things very perfect to do that. I'm going to be a little bit more conservative. This is also my multiplier number. This is the number I can use to figure out how much I need to invest in my hedge to protect my portfolio. So I'm going to take my multiplier number and just multiply that times 0.8. I'm assuming I can make about 80% of that profit. Gives me a little wiggle room. My new multiplier number is 10. Okay, great. Let me show you how to use this. Before I told you if the market blows up and I have normal portfolio on, I'm going to lose about $7,000 to $8,000. So $8,000 divided by 10 is 800 bucks. Great. Now, this is going to cost me $22 per position. If I want to spend $800 on that, just divided by 22, I would take 36 of these. Okay, here's the trade. We've got 36 contracts of a 52 by 55 bull call spread that expires in December 16th or December 16th. And hold on. By the way, I've got so many of these floating around that it's tough. So if the market goes nuts and we shoot up here, actually let's move this up in time a bit. Let's say it happens mid-November. We are up in the 60 range on VXX. The profit on the trade is about $6,800, a little bit less than my $7,000. So how do I actually use this? And by the way, I've only spent, let's see, 36 times 22. 36 times $22. I've spent $792, and this is to cover a $100,000 portfolio. So I've just put $792 insurance on here. By the way, this is a cost. This probably is not going to make us money. But what it does do is also very important. The market goes nuts. Everything just goes sideways and bad. Step one, get rid of your risks. Focus on your portfolio, focus on your bad trades, close them. Get them off the table. Don't try to figure out what exactly might happen next. Don't try to game the system. Just close them. Walk away from the trades. Step two, we now have a portfolio that no longer has any particular risk in it. Now, that might mean we leave some bear call spreads on because, hey, they were making great money anyhow. But we don't have any risks that things are going to get worse in the next day or two. We turn around and we close this trade. At this point, we harvest 6, 7, depending on where we are in the whole situation, maybe $8,000 worth of profits. We've lost a bunch of money on the trades we were trading. We gain a bunch of money on this. It ends up neutralizing, and maybe we lose a little money, but we're not losing 8, 9, 10% of our portfolio. We're losing 2%, which for me is a reasonable situation. I can live with that, especially considering I suddenly am free to go and make money in a ton of other ways, and a lot of opportunities pop up around corrections like that. The key, though, and this is what's important about this, is I just spend $800. I spent it, didn't invest it. I'm not going to make a profit on it likely. As a matter of fact, I want to lose that money. But it lets me clear my head so that when I'm trading everything else, I can actually look at what is going on in the market right now and not freak out about what might happen. Because if I'm going back to that iron condor that I had in the beginning of this session, and I sit there and I say, well, what happens if the market corrects? I could go down and blow right through my 192 strike. Well, yeah, you could. But as long as I have that VXX hedge on, the money I just lost from this thing going down is going right back into my pocket because the VXX, I didn't need to care about this. And profitability-wise, I'm better not caring about it. As long as I have the insurance, I've hedged off that risk, I stop caring about that as a risk and I focus on ways to make money. This has been a very, very profitable approach because there's a lot of opportunities to make money right now. But we get scared away because the risks are out there terrifying us that if the trade blows up in our face, we're going to take a huge loss. Make that go away, stop thinking about it, focus on the way to make money. All right, so there was 3, probably not in-depth, but concepts that you can use right now and hopefully will help you think about your trading and give you some opportunities to make some more money or control your risks. That was what I wanted to give you. Constantine, what about UVXY? You guys can list a dozen of those things and the answer is yes. Here's the key. Understand what they're going to do, in the situation of a crash. VXX, I think, is one of the easiest to understand. Understand, are they going to erode? Are they going to do something bad in other ways? Maybe they do, maybe they don't. And set up that highly leveraged, low probability trade that would take advantage of that in the case that something bad happened. It applies. I mean, to be honest with you, you can do the exact same thing to the SPY. You could do it on you could do it on the Russell. You could do it on the inverse. You can do it on any of these. I choose to do the VXX because it's, number one, focused on volatility, which is what a lot of my trading is focused on. I understand it well, and I know how to manage and do the trade. You can go in other places, and there's no reason why you couldn't do something just as effective. But I can't teach you every single one of those tonight. Now, the one thing I would say is don't go off the beaten path too much. VXX is great because it's got a ton of liquidity, it's got all kinds of volume and options on it, and it's easy to manage as a trade. You're in and out of it, no trouble at all. You start to get into the UVXYs and some of the others that, UVXY may not be a bad one, but others get very thin, and you may not be able to make the trade work. So just pay attention to those factors. But yeah, explore other options. All right, I'm going to wrap this up. I've already gone over my time. People are going to be upset with me. Quick question for everybody, and this is a little feedback from me. What we talked about, and I know I blew through it fast. I normally don't do that, especially for any of you who normally have heard me. They can attest. I take my time, I work with everybody, and I do my damnedest to make sure questions are answered fully. But the little you did get tonight, was that something you think is valuable? Do you think that it's useful to you? And I'd love to know. Okay, good. Oh, thanks. Appreciate that. How would I differentiate my style from Dan Sheridan's? Honestly, I haven't compared my style to Dan Sheridan all that much. This is built out of years of quantitative analytics, mathematical modeling, and kind of focusing on risks and things like that. I probably have my own kind of bizarrely unique view of things. I'm not sure how to compare that. I've never really been asked that question. Oh, thanks, Brett. Okay, I am going to move on because this is also one of the things we got to do. If you liked what I did, if that style of idea intrigues you, if it's something that you think can help you improve your trading. Now, let's just be blunt. If you are a day trader who's in and out of things 15 times in a day, probably not going to help you. And if you are somebody who just wants to do covered calls on stocks that they've got in their 401k and they're going to do that for the next 5 years, I can probably add some value there, but probably not so much. But if you want to be, a moderately active but not overly aggressive options trader, focusing on controlling risks, identifying a lot of unique opportunities to find some good trades, to build out portfolios that are balanced and safe and manageable. If that's something that interests you, the lab is something that could be very valuable. So this is October 24th to the 28th. It's a fairly intensive lab, about three hours each day. We go in depth in a wide variety of different tactics. I teach you how the tactics work, why the tactics work, how to modify them, how to manage them in different situations, where they apply and how they can be used the best to make money at certain specific moments. Go through a whole array of things. The goal is to take you from having a basic understanding of options and to bring you up to the point where you've got a deep understanding of a broad variety of different tactics and how they can be used together to create a portfolio that's a profitable and solid portfolio. That's coming up in the near future. I'll let Sammy get into the how to do that if you want, but that would be good for you if that's what you want. Now, on top of that, that's education. That's an important piece. You have to know what you're doing and know what you're looking at to be able to do it on a regular basis. We also have the Options Strategist newsletter. Now, honestly, I hate calling it a pet peeve of mine. What it is we are actively trading a classroom portfolio. We're keeping it full of active, timely trades, and we're trying to build out a portfolio like I've just been describing. And that means that we are constantly adding positions to it. We're taking risks off the table, we're adjusting things, we're closing profits, we're closing losses, and we're managing it just like we manage trading. Now, what that allows us to do is a very hands-on, practical education and working through timely problems in the market right then, creating a trade, learning by doing. Now, that's the other thing that I believe that they're including in this, and I'm going to hand off to Sammy here to give you any of the details of that, but I believe if you do the lab, you get 12 free months with the Options Strategist newsletter. Now, one thing that comes along with that is we send out alerts and updates and information on a regular basis during the week, but every week we also have about a 2-hour session, maybe 3 hours sometimes, where we're live. Anybody who's part of the program can join us, ask questions, And for those of you who didn't get your questions answered, I actually don't like that. I feel bad. That's the time when I can dive in and literally probably go to the point where you want me to shut up about things. That it can be really valuable because we'll dig into how something's working, why it's working, how to use it in the future, why it might fail, all of those things until you really understand it. And then we're practically trading. We're opening and closing the trades within the group. Everybody can see what's going on. So those are the two things. I'm not really so much the salesperson. I like my program, so I like to talk about it. I will ask Sammy if he wants to join us. The newsletter is actually a combination of alerts for trades, managed portfolio that's actively managed in front of the whole group. And you can see the ins and outs. And every week, having a live session that, if you'd like, you can join, ask questions, dive deep into what's going on in the portfolio. And they're really, I consider them pretty good learning sessions. We always are going into depth about the trades. Good opportunity to learn. The lab, this is the rundown of it. Understanding options on day one, we go deep into what, how, why, not just what an option is, but why is the price that way, what drives the prices, what makes things change. So you have a really good fundamental understanding of options. Day two of the lab, strategic directional plays, vertical spreads, things along those lines, using delta and direction to make money. Day three is focusing on income. Income as a strategy. Day four is time strategies, calendars, things along those lines. Also playing with volatilities. And then day five is one of my favorites, fear, uncertainty, and doubt as a strategy. This is playing on implied volatility changes in the market, and there's a lot of trades out there based on that. It's a whole world of trading that you can make, you can have as your playground, basically, if you understand what you're looking at. Okay, we've returned about 20.9%. So far this year, we've been doing pretty solid. And by the way, that was also including one little pullback or drawdown that I wasn't happy about, but we are solidly up right now. Live weekly sessions, and honestly, we do a variety of trades, a very wide variety of different trades. So, and I'm open to discussing your own trades, your own trade ideas with you. Okay. Sammy, are you out there?
I am right here, sir.
Okay. Sorry about going over on time. I know I'm going to get my wrist slapped on that one. You know I don't like to shut up, though.
Don't you worry about that. I'm here. I'm staying here as long as anybody has any interest because, folks, just tonight and tomorrow only, our 25% off sale will be ending tomorrow evening at midnight, September 30th. So with that, Doug just explained, you will be receiving 1 year of the newsletter completely for free with your purchase of the lab. The lab typically is $9.95. Tonight and tomorrow only, $746.25. All you need to do is email into info@t3live.com. Or you can email me direct, sammy@t3live.com. I'm sending both messages in both the question box as well as the chat box. You could check out exactly there of where to email in. I'll be waiting here all night. I'll be also answering emails, phone calls, and questions all day tomorrow. So if you miss me tonight, no worries at all. I will get in contact with you by tomorrow. But this is a great deal. I understand that what Doug may have shown you may be a little bit advanced for new options traders. However, as we did indicate, days 1 and 2 in the lab, we will go over some basic options practices just to make sure we know what level of options expertise you folks are up on. So Doug's one of the most fun people I've been around. First and foremost, we had a lot of personal fun back in December of 2015. We won't go into full detail about that, but definitely had a great time.
Yes, we won't go into full detail about that one, Sammy.
Definitely had a great time, but he's even better. As great of a person as he is, he's a great mentor just as well. As he mentioned, he will take the time to understand where your frustration lies and to answer the particular question that you have at hand. Typically, our subscription cost for the Option Strategist is also $9.95. That's also 25% off as well. However, you know, why would you pay for one or the other when you get both when you pay for one? So our next lab, again, is the, what was it, the 24th, Doug, if I'm not mistaken, of November? I could be wrong.
Yeah, I believe it's the week of October 24th.
That's correct. So Monday through Friday from 2 to 5 p.m. Eastern Standard Time, you have 3 hours a day with Doug. And then not only that, because you have the free access to the newsletter, keep in mind every Wednesday, Doug does a very detailed session. However, I can only hold on to this 25% discount for tonight and tomorrow. So folks, it's imperative if you want to join up at a discounted price and get 1 year of guidance from Doug to build your options portfolio and beat the S&P as we've been doing now, you know, obviously give us a call, send me an email. The phone number is right there. My email again, sammy@t3live.com or info@t3live.com. I'll be here all night waiting for you folks to call in or to email in. If you call in, just keep in mind I am one person, so I will probably only be able to be on the phone for one call at a time. Email may be a better way to go about it. So with that, I have nothing more, Doug. I'm not sure if you want to stick around and answer a few questions, but I'll flip it back to you.
Hey, I'm pretty well set. I mean, I can take a question or two, but I actually also have to get running on too. My wife is. I normally cook dinner, and my wife very wonderfully offered to do it, and it's going to be ready in just a minute here. Um, Greg, does lab completion? Are you talking the daily room, the VTF room? Sammy might be able to answer that one a little better than I would, because I'm not. I do actually participate in the VTF periodically, but it's not my primary focus. Um, Options Strategist is the newsletter. It's just the Options Strategist program is the name of the newsletter. And once again, I really hate calling it a newsletter because that's not what I feel like it is. It's really focused on, you know, a kind of continuous management of trades, exchanging information, and especially the weekly sessions. Where we get to dive into the questions and really dig into the trades. And we put, by the way, we put a lot of trades on live during those sessions too. We spend a lot of time taking trades off, closing them, managing trades, understanding what we're going to do for trades, and putting new ones on. So newsletter for me doesn't quite describe it. A little different, but I guess newsletter is the term people like. Um, Remington, on the double calendar that we talked about, what if the price hit the upper end and volatility goes down? Well, if you're near the strikes, the volatility going down won't hurt you too much. But if you're further away from the strikes, either in the center or past the end, past the strike above or below, you would actually lose money by implied volatility going down, which is one of the reasons why I took that trade now with the volatility being quite low. One of the indications for taking that trade is that the volatility on the stock is at the lowest edge of its own range. Now, I'm in a little bit of a tough position here because I need to be able to show off a good example. Herbalife happened to be a pretty decent example, but I would probably have wanted to take that a couple of days ago when implied volatility was lower. And if implied volatility goes up, that means that there's more room for it to drop back down. Makes it a little bit worse. You want to be able to spot the opportunities and be able to take it when it's ripe. So you don't, you do want to be aware of that. It is absolutely one of the worst decisions or the worst misunderstandings a lot of people who do calendar trades make is that they don't pay attention to where volatility is. They enter the trade when volatility might be mid to high within its own range. When it falls, it really does hurt. So it's a good catch on that, and you do want to be very careful of that. What if market goes against positions? Okay, in between the weekly seminars that we do, the weekly sessions, I'm regularly sending out alerts, updates, We send out trades on the portfolio all the time. So if we're closing something and I'm putting an order in to close it, you'll see an order you'll see an order report that comes to you by email. Then when that order gets filled, you'll see a fill report come to you, lets you know what's happening. You get details as it goes. And I try to get those out right as I'm doing them. Normally you should see them within 3 to 5 minutes, typically, of the moment I'm pressing the button. And once in a while it might be a little longer depending on what's going on, but it's fast. So that's books on long-term option strategies. Bread. All right, it depends on the person you are, but this is if you can stomach it, okay? And about 50% of the people come back to me say, "Oh my God, what did you make me read?" If you can get through it, and it's your style of book, there's a book out there called, actually, I've got it right here on my desk, Options, Volatility, and Pricing by Sheldon Natenberg. If you were to go to Chicago and you were to be hired by an options trading firm, they would likely give you that book when they hire you. It's the Bible of options trading. Now, it's focused on commodities options, but don't let that, distract you. The concepts are exactly the same. It is an amazing book for really deeply understanding pretty much everything about practically trading options. Now, I can give you half a dozen that are more mathematical, and I can give you a bunch that are fluff. The ones that are fluff, I hate recommending them because I don't feel like they actually teach you anything serious. And the ones that are just too densely mathematical, unless you're a math geek, you'll just zone out. If you are, talk to me and I'll give you a list. But that one kind of hits a sweet spot. Options, Volatility and Pricing by Sheldon Natenberg. Now, I will give you one other warning on that. He did write a few other books. I love that book. His other books were phoning it in. I have no idea what happened. I guess maybe his publisher wanted him to make some more money, whatever, but he put a half-hearted effort into them. That one book is probably the best one out there. Options, Volatility, and Pricing, you don't have to be a math geek to get through. It's going to be some math, but it's not hardcore. And if you have a good, solid high school math education, you're fine. Don't worry. Focus on the concepts. You don't have to get every formula perfect. But options do use math some, so it kind of comes with the territory. That's the one I would recommend. Even if you get frustrated with it, you're going to learn something from it. For relative implied volatility evaluation, what time periods do I prefer? Jim, that's a tough question. I'm normally doing what I would consider kind of an informed view of the market. I've been trading for a while, so I know that leading up to, early 2015, we were in a long bullish run. I would treat that period a little differently than, when we flattened out and kind of went sideways. We've certainly seen a lot of volatility in the last, 9 months in this year. What I'm looking for is the general idea, the range of the volatility on the stock, which you can actually see pretty clearly in the charts. You can get a good general idea. And just applying a little knowledge of what's going on around us to say, is this out of the normal? Do I think it could go any lower, or is it pretty much bottomed out? Stocks have a natural range of implied volatility. A more volatile, crazy stock will typically have higher implied volatilities. It will have a higher low on its range and a higher high. Super boring stocks, REITs, oil pipelines, gas pipelines, I could practically tell you what they're going to do 3-4 years in the future. The low end of their implied volatility is super low. You want to look at the way that the implied volatility has changed over the last 2 to 3 years of that stock. use a little common sense, understand that the world is slightly different now than it was a year ago. That should give you a good idea. Generally, I'd actually look out 2 to 3 years. Normally what I do, Jim, is just pull up a 3-year chart and I look at the historical, not the historical volatility, the implied volatility chart for that 3 years and get a little sense of what's going on. I put the most important numbers over the last year. Outside of that, it's a little bit of a judgment call. What's the worst year for the trading room in terms of percent? Man, I don't. It's a hard one. I mean, ever since I've been working with T3 for the last couple of years, and I've made a profit every year. Right now, I'm up about 21% for this year. Let me see. I'm trying to give you a sense of this. Okay, I got to be careful because I really can't veer into, promises, getting expectations up or anything like that. But I would say that a typical decent year could be anywhere between 20 to 30%. I'd say that's a reasonable target. Understand very clearly that I'm not somebody who's going for home run hits, trying to make 300% in a year, because bluntly, what you're going to do is you're going to eventually blow up, and you're going to lose a bunch of money. I'd much rather have a continuous steady flow of income. I have had bad years in the past. None of them have been terribly bad. I think the worst of them broke below like 10% down, but that wasn't very common. And it's also very hard for me to compare that to like the high frequency and other trading jobs that I've had. So tough one. Hopefully that gives you an idea. I don't have a sheet of things to say this is exactly it, though. No, it's fine to have a tough question. It's a hard one to answer. And understand that, I live in a world where we're very regulated by the SEC. All right. And I could take my live trading portfolios, which I can't because, number one, they're not my money and I'm managing someone else's money. And I could point to those and the SEC would blow up at me and get I would get fined and potentially lose my job. There's so many rules we deal with. For the classroom, been profitable, been solidly profitable. Right now we're on track for 20. Well, actually, no, we're not on track. We have 21% under our belt. And looking to keep that up. All right. Anything else? I do need to wrap this up because I have a 6-year-old daughter who is going to be mad at her dad because she's not getting her food. But anything else? Is anything I can answer a question on? Well, I look forward to seeing you soon. Hopefully I'll see you in some of the upcoming seminars, and I would love to see some of you in my Options Strategist group, and absolutely love to see some of you in the lab. The lab deal is really a good deal. I mean, even if you are a good solid options trader and know stuff, we cover a lot of information, you learn a lot, and it's always good to, fill in the gaps, to take some education. And basically you're getting a year of the Options Strategist program group, the newsletter, and the lab together for less than the cost of the lab by itself. It's a pretty decent deal. So if you think it would be helpful to you, love to see you there. All right, then. Next week's lotto numbers, I have no clue. I stink at lotto. I can lose money on lotto every week if I try. I'd rather do something I can win at. All right. I will talk to you later. Sammy, did you have anything before we wrap this up? Otherwise, I'm going to shut us down and head to dinner. Oh, I think we're good. Good night, everybody. Thank you for showing up. I appreciate it.